If you have a checking account and you're over 60, several reporting rules this year may affect you, and many people never receive a clear notice about them. No personal letter, no simple postcard, just technical guidance, bank compliance systems, and tax reporting updates that many seniors right now may not realize could matter. I'm covering all three today. The number you were taught to watch that does not fully protect you, the everyday banking habit that can create questions, and the family transfer that may be mistaken for taxable income. Stay until the end. The last one is the situation many seniors may already have without recognizing it. Hey, I'm Masha. I break down financial and legal information every week that actually helps you protect what you've built and make retirement easier to manage. So, if that's useful to you, go ahead and subscribe so you don't miss what's coming. Here's rule number 1. The number most seniors remember is $10,000. Stay under it. The thinking went, and everything is fine. That understanding is incomplete. Under the Bank Secrecy Act, a cash transaction over $10,000 in one business day generally requires your bank to file a currency transaction report with FinCEN. Your name, social security number, date of birth, and transaction details may be recorded and filed within the required time frame. You usually will not receive a copy. The bank also cannot discuss certain compliance filings with you. What matters now is not only what happens above that number. Banks also review activity below that amount when repeated transactions appear unusual or seem designed to avoid reporting. The threshold is not your only concern anymore. The pattern around it matters too. There is also another report many seniors do not know about, and it has no fixed dollar floor at all. A suspicious activity report, or SAR. A bank may file one on a smaller transaction if its compliance system or staff believes the activity needs review. These systems look at behavior, not just amounts, and you generally will not be told if one is filed. Federal law restricts bank employees from tipping customers off about certain reports. Worth knowing too, money orders and wire transfers above certain amounts can require identification and record keeping under federal rules. Even when a specific transaction does not create the same report, the bank may still keep records connected to it. This applies at credit unions the same way it applies at national banks. There is no special exemption simply because an institution is smaller or local. If you've moved your accounts to a credit union thinking it operates outside these rules, it does not. Federally insured institutions follow Bank Secrecy Act requirements, which means the safest move is not switching banks. It is understanding what can cause questions in the first place. That leads into rule number 2, the one that can turn an ordinary habit into a compliance question. Take Diane, 67, a retired county clerk in Albuquerque. For 11 years, she withdrew $800 in cash every 2 weeks for household expenses. After her husband passed, she raised it to $1,000 to cover bills he used to handle. Several weeks later, her bank system flagged the account for review. Diane did nothing wrong. She was a widow adjusting her budget, and the system read the repeated change as something that needed explanation. Diane did not learn about the concern until months later, when a routine account review at her bank noted questions tied to the earlier activity, and a compliance employee asked her to explain the change in her withdrawal pattern. She was able to clear it up because she still had old receipts showing the increase matched new bills she had taken over after her husband's death. But she said she had no idea until that conversation that her normal banking pattern could ever raise questions. The issue is often called structuring under Title 31 rules. In general, structuring involves arranging transactions to avoid reporting requirements. Banks may review repeated withdrawals or deposits below $10,000 if they appear to fit that pattern. Regular cash withdrawals are not automatically illegal, and using your own money is not a problem by itself. The concern is whether the pattern looks like an attempt to avoid reporting. If you use cash regularly, the fix is documentation. Keep a simple note with the date, amount, and purpose. If you move larger sums between your own accounts, consider doing it in one clear transfer instead of several smaller ones, and add a brief memo. Before the last rule, check your last 90 days of transactions. If you see 3 or more deposits between $5,000 and $9,500, write down the source and reason. You will want that for the steps at the end. Now, rule number 3, the one involving money that never felt like income. Your daughter sends $400 through Zelle for groceries. Your son sends $600 through Venmo for a car repair. None of it felt like income. In many cases, it is not. But under updated 1099K reporting rules, third-party payment apps like Venmo, PayPal, and Cash App may report cumulative payments to your account once they cross a set threshold in a calendar year. The IRS has been phasing these rules in, with lower thresholds scheduled over time. Zelle generally works differently because it processes as a bank-to-bank transfer, so it is not usually handled the same way under 1099-K reporting. But if money is actually business income, it is still taxable regardless of the app used. When a processor reports payments and your tax return does not explain them, IRS matching software may flag the difference automatically. That notice is often called a CP 2000. It is not the same as a full audit, but it is a proposed adjustment, and it may include interest. Patricia, 71, a retired home health aide in Memphis, received one in March saying she owed $1,840. She had not worked all year. Her 3 adult children had sent her $3,200 total through Venmo for prescriptions, bills, and a new refrigerator. The reported payment total did not match income shown on her return, so the system created a mismatch. She had a limited time to respond before the proposed amount could move forward. The fix: have family members write personal gift or family support in the memo line when they send money and keep a simple log. Gifts generally are not taxable income to you, but you may need to show what the payments were. One more thing many seniors do not realize: the IRS generally has 3 years from the date you filed a return to question it, but that window can extend to 6 years in certain cases involving substantial omitted income. That means a payment app mismatch from 2 or 3 years ago may still surface later, even if no notice arrived at the time. If you've been receiving regular family transfers through these apps for years without tracking them, it is worth pulling your last few years of app history now, not just this year's, so you're not surprised by a notice covering a year you had already forgotten about. So, here's what I want you to do. The exemptions, the breaks, the refunds, many seniors may qualify for but never claim. I put them all in one place, state by state, form by form, so you don't waste hours digging through government sites. Everything is laid out clearly and simply so any senior can find what may apply to them. No matter what state you're in, there may be benefits or savings you're missing. It's called the Senior Exemption Playbook. It's in the first pinned comment right below this video. Just tap it once and you'll have everything you need. Now, stay right here because the last rule is the one many seniors may already be dealing with without realizing it, and it's the reason I made this whole video. Here's your action plan, and do these in order. Step 1. Request your free ChexSystems report and check it for flags, errors, or closures you were not aware of. Step 2. For the next 90 days, log every recurring deposit, source, amount, and date. If family sends money through an app, ask for a one-line note confirming whether it is a gift or personal support. Step 3. Consolidate planned transfers between your own accounts into one clear move instead of several smaller ones, with a brief memo describing the purpose. Step 4. Add up every Venmo, Zelle, PayPal, and Cash App payment you've received over the last 12 months. If the total is significant and was not addressed on your last return, gather your documentation now before any notice shows up. Step 5. If a CP 2000 arrives, respond in writing before the deadline printed on the notice, not the date you opened it. Include a brief explanation, documentation, and a signed statement. If the proposed amount is large, or if you are unsure how to respond, contact a licensed tax professional first. Step 6. Consider placing a free security freeze on your ChexSystems file if you are not opening new accounts soon. It should not affect existing accounts, but it may help limit new account screening activity going forward. None of these situations always comes with an easy warning. Your bank may not be able to tell you about certain compliance reports. A payment app may report transactions without explaining the tax result to you. That silence is part of how the system works. Knowing the rules, keeping notes, and documenting as you go is what helps keep a quiet question from becoming a real problem.